Okay, we're continuing along with employment inclusions here. We learned the basics in the last week, and now we're going to move into two complicated areas. One, employment insurance benefits, and then two, stock options. So before we can understand the taxation of employment insurance benefits, we need to make sure we understand the mechanics of employment insurance. So I think most people have a fairly basic understanding of how insurance works. So if this is time that we're charting from left to right, then each period, usually a year, the person or whoever is contributing money to this plan that is essentially protecting us, protecting the employee should something happen. And when that's something that prevents them from working, and when that something happens that we normally refer to as an event, then everything changes and the person is no longer able to work. So instead of receiving their salary for working, in exchange for working, now they are receiving these benefits that they are entitled to because of the agreement that they've made with the insurance company. So that's the basics of the cash flows. The question is, well, what's the taxation of it? And the answer is it's a bit complicated. So I have taken this from page 110 of Beam, Lakin, and Barnett. So that chart is there. I'm going to do it just a bit differently. But the government says, well, it matters. We're going to treat things differently depending on who pays the premiums. And so it gets awfully complicated. So let's look here, although each of these cells in isolation is not that complicated. So what we want to look at here is the effect on the net employment income of the employee. So what that means is they can either have a benefit counted as income or not, or they can either have a premium be deductible or not. Okay, so there's really two choices for each way. And so we've got another set of distinctions between whether the plan is group or non-group. So let's just assume group plan, which basically is the most common in most places, and it says we'll do the same for all of our employees. So the employees as a whole are a group, and we're going to pay into it for them. So if the employer, I'll start right here, if the employer contributes anything, any premium, the premium is not a benefit to the employee. So the government has said we will not consider that to be an income inclusion because we don't consider it to be a benefit. However, when after the event the cash starts flowing out, we will include, so I'm just putting an up arrow here for increase. So this means the employee's net income, net employment income for the year in which they collect a benefit goes up by the amount of the benefit. Well, what if the employee pays the whole thing? So the employer is not contributing, but the employee is. Well, in that case, they do not give them a deduction, so you don't get a deduction for the premium. So you pay out an amount, you're putting away money into paying the insurance company money. That is not deductible. So those are after-tax dollars. So that's why that up arrow is there, because your net income is higher because you did not get a deduction for that amount. However, if you need the benefits, when you collect them, they are not included into your income. Okay? Now when we go over to the non-group plans, this cell stays exactly the same, as does this one. So the stories we just told for group are exactly the same for non-group. However, when it's an employer contributing to it, and they don't have to pay the whole thing, they just have to be contributing to it. When they do that, the government treats it oppositely. So this is essentially a one-off thing. You're not contributing to a group. So in that case, we are going to include the premium as a benefit. But when it comes out, and the premium is an employment inclusion that year, so that's why it matches the one just to its left perfectly. And then when you get paid the benefit, it is not taxed, is not included in your income. Okay, so you can see when you look at these groups one at a time, you can see one of them increases and one of them doesn't. And so there are choices to be made. Basically, when do you want to be taxed? And it becomes gambling as to what choices are made, because you can either have small amounts now and large amounts later, but of course, there's a lot of people who never will collect $1 of benefit because the event won't happen to them. Moving on to stock options then, we need to do exactly the same thing and make sure that everybody has at least a basic understanding of what they are before we can understand how they're taxed. So with stock options, the first thing we have to realize is these are a right to buy shares. So the option, when the option is granted, all that is exchanged is a piece of paper that says you can buy these shares at this price starting at this date. And then it's a choice that you're given. Secondly, there are 3 dates that matter. We talk about them as call them the grant date, the exercise date, and the date of disposition or sale. Okay, and so this is a timeline that we're looking at right here, and it's important to note that this could be 10, 15, this could be any number of years. This is usually not a short time period, and that's going to cause us trouble when it comes time to talking about tax. Timing is going to be an issue because we divide tax into years. And if it's spread over multiple years, we're going to have some issues. But first, let's make sure we understand again what's going on here. So when an option is granted, this is a contract of some kind is signed and an exercise price is agreed on. Okay? That's all that happens there. No money changes hands. Then, at exercise, the employee buys the shares. Okay, so this is a cash outflow, buys for the employees, a cash outflow. And then when the shares are sold, well, shares are sold. The employee sells them. Okay, so that's the mechanics of it. And it's important to note there are 2 important prices at every point in time. So at the grant date, there's the price that these shares are selling for on the market. So we often call this the fair market value. These are what they're selling for on the open market. And then there's this X price, the exercise price, which is set again by contract. So it's not going to move. Then at the exercise date, there's a new price. More than likely, the price has changed by the time we get to here. So the price at grant is probably not going to be the price at exercise. But the exercise price itself is sometimes called the strike price, is going to be, it stays. It's written in a contract somewhere. So it's going to be the same price. But the price at exercise is the fair market value, so the price that would have been paid on the open market. And then this price here is just, again, a new market price, and we'll call it the price at disposition. Okay? And so probably best to look at this in a scenario. So let's imagine an employee is given stock options. So at the grant date, at the time when she's given them, when she receives the option, these things are selling on the stock market for $12 a share. And her exercise price that she's given is $10. When it comes time that she's able to exercise and buy these on the open market, they're selling for $18. Her exercise price is $10. So she buys these. So if it's 1,000 shares, she pays $10,000 and receives 1,000 shares. Then in the future, at whatever point she decides she wants to sell them, say they're selling at $22. So this is not too difficult for us to figure out what has happened here, right? Here's what's happened. She has proceeds of disposition. So hopefully you're familiar with this term, proceeds of disposition. What she got for selling them? $22. Her adjusted cost base, let's just call this cost, was what? 10. So this is what we call a capital gain. And if it weren't for the fact that we're in the world of options and these shares were bought as a result of holding an option, then we're done. We know how to deal with the taxation of this. At least it was talked about in 201. But is this really what happened? Is this cost really 10? And the question, and it seems like, well, actually, no, it's not. Because in here, she got something that was worth 18. She paid 10, but what it looks like is she got a discount. And it also looks like she got a discount as a result of her employment. And that sounds like an employment benefit. So we look at this and we say, wait a minute, what if the ACB was, or the adjusted cost base was actually 18? Well, then her gain is 4. And so we look at it and go, okay, well, so what is it? And so this is the problem. This is this, she's clearly up 12. Nobody would argue that. She's up 12 in the transaction. Is that 12 a result of a capital gain, or is that a result of income, or is it a result a little bit of both? And the answer is it's a little bit of both. So this is income. This is employment income that we're used to, that we've spent the last little while figuring out when it is and when it isn't. And this is a capital gain. So that's how we treat them. However, there's further questions to ask. Well, what about the timing? Because again, remember, these are spread over multiple years. So you go back and look at the timeline, there could be, 10 years pass in this time. So when should we tax it? The government would like its money sooner, and she'd like to hold on to her money longer. So when do they tax it? So again, let's just get this down. We've got employment income, we've got employment income of $8, and we've got a capital gain of $4. And so the way this is treated is this is taxed at exercise, and this is taxed at disposition. So these could be years and years apart that these two things get taxed. Okay, so there are two main exceptions to this. There used to be more, but this area is actually changing as we speak. So it's kind of a hot topic. One, if the price at grant had been less than or equal to the X price. So back here they weren't. An example I used, 12 is bigger than 10. But if this had been set at 10 so that it was equal, then that would lead to her being able to get a deduction equal to 1/2 of the employment inclusion. So in her case, that's a half of $8,000. So she would have owned, her income inclusion would have been, in total would have been 8 minus 4. So she would have included 4 in her income had they set the X price better, more smartly. Second exception, if the company is a CCPC, so a Canadian-controlled private corporation, which we will talk about what that is, there are two things that they can get. One, the income inclusion, so this $8,000 can be deferred to disposition. So that's a big deal. And it used to be that everybody could get that, but they can't anymore, as we may get to. And B, they can have this same deal, this half deduction, if they hold the shares for 2 years. So if you hold the shares for 2 years, you can still only pay tax on half of the employment inclusion, regardless of, so independent of this test that we talked about up here. So regardless of the strike price, if it's a CCPC, you can have this half deduction if you hold them for 2 years. Okay?